I'm Sebastian St. James. Today I will show you how to beat the stock market and how you can make $149,745 in just 10 years. Yes, I know. All this comes from a brand new index that I've created, and I will reveal the details to you in full. To understand this index, we first need to understand a weakness that you as a human have. And that's being a sheep following the crowd. But according to Warren Buffett, you should be doing exactly the opposite. Be fearful when others are greedy, and greedy when others are fearful. In a previous video, one of my viewers said, "Hi Sebastian, thank you for your videos. I thought of 2 different strategies to beat the market." Today we'll deal with one of those strategies, the second one we'll do in a future video. Using the fear and greed index, dollar cost averaging into the market when the sentiment is low. That I can do. CNN has created something that they call the Fear and Greed Index. It's an index that they personally have created that contains a mishmash of very questionable things. And here it is. This feeds into their index. So I can't buy the S&P 500 until I check the prices of junk bonds? Really? And that's what they call a strategy? I checked with Ivan to find out whether it's this that he's asking about or whether it's a general concept. And he told me, no, it's actually the general concept. So, no junk bonds for you. Today, we'll use a brand new index to exploit fear and greed and to make money on the stock market. Brand new, you say? How new? Using the powers that only I and the Standard & Poor's possess, today I will create a brand new index called the Fear and Greed Index. So, how does it work? To create this, I went back to first principles. What is fear and greed really when it comes to the stock market? Here's a graph of the stock market. Notice that there are lower highs and lower lows, which indicates what? Well, it just indicates that the stock market's going down. Does this indicate fear? No, not necessarily. The stock market goes down regularly. Where is the fear? Where is the passion? This is a down market that's full of fear. Oh wow, I can see that. See that sudden drop? That there is extreme fear. It's the suddenness in the drop that tells us that people are afraid and that they have to get out of the market at any cost right now. So a sudden drop in the stock market shows fear, a slow decline shows a decrease in sentiment, but it's not the same thing as fear. Based on this profound insight, I have created a brand new index specifically for this video. And here it is. Oh, wow. This is the Fear and Greed Index over the last 38.7 years. We are seeing an oscillating curve which represent levels of fear and levels of greed. Okay. So which is which? Because this is the Fear and Greed Index, not the Greed and Fear Index, then the positive values represent fear and the negative ones, greed. So, what sort of numbers am I likely to get out of this index? It ranges between 100, which is ultimate fear, right down to minus 100, which is ultimate greed. I googled ultimate fear to see what you lot are afraid of. And this is what I found. But I believe some of you have already wet your pants. Based on this, what was the most fearful day in the history of my data? We'll take a look. 100% fear occurred on the 20th of October 1987. Oh, ha! Well, that was a global financial crisis. No wonder that was maximum fear. Here, take a look. And there it is on the graph. Ultimate fear right there on the sharpest drop of that curve. Wow, working as expected. All right, so how do I actually calculate fear and greed? Well, fear is the percentage drop in price over one trading week. Hang on, a trading week? That's really small. Why so short? Because I wanted to detect markets like this. On Monday, October 19, 1987, the Dow Jones Industrial Average plunged almost 22%. Black Monday, as the day is known, marks the biggest single decline in the stock market's history. But I don't want to detect headlines like this. With the S&P 500 in the longest bear market since 1973, individual investors maneuver differently from just months ago. You see, humans have an amazing ability to adapt, so fear by definition only lasts days or maybe weeks, but certainly not years. The market crashed today by 22%. People are in fear. We've been in a bear market for 2 years. People have accepted that the market will continue to go down and have moved on with their lives. Now, there's no reason why you couldn't measure both, the fear index and how much the market has been oversold. But for the point of this video, we want to only measure abject terror. The question is, how did I get this index to neatly line up between 100 and minus 100? I mean, that's some pretty fancy maths there. Oh, I scaled it. We take the worst day on record, we give that 100 points, and we scale everything else so that equals 100. And the same on the best day, we give that minus 100 and then scale everything so it equals minus 100. Good. Well, that's nice and neat, but let's see how this index works in practice. In blue up above, we see the fear and greed index. In red below is the all ordinaries, right. Now, because this is a fear index, of course, it's going to be opposite to the direction of the stock market, but here is where it differs. You can see in red, the stock price is plummeting. The fear index, therefore, is shooting up to match that. After that, the stock price continues to drop. However, notice that the fear index is actually coming off its peak. Why is that? Well, the sharpness of the drop of the share price is not so much. You notice it is still dropping, but it is tending to flatten out, and therefore the fear index is leveling off. So we've discovered one thing. Fear is not equal to the price drop itself, but fear equals a sudden price drop over a short period of time. Now we have this new fear and greed index. What are we going to do with it? If the fear index is low, keep your money in cash. If the fear index is high, then you put your money into stocks. This is Andrea. Andrea invests $1,000 per month. Oh, good for you. She dollar cost averages into the market. All her money goes straight into the market, and she buys a number of shares depending on the share price at the time. This is Moose. It's a nickname given to her by her father. Apparently she grunts in her sleep, but you didn't hear that from me. Moose tries to invest $1,000 per month. She buys shares only when the fear index is above 50. Remember, it can go all the way up to 100. And she holds cash until that threshold is met. Okay, well that's different. So they're investing the same amount, or trying to. However, one is holding cash until the market is ready. The other, no, invests straight away. Here is the high interest savings account interest rate over the last 41 years. Okay, so these are Australian figures. The average of that is 4.5%. In our test, if anybody's holding cash, and it will really only be Moose, then she will get 4.5% annualized for the amount of time that she's holding the cash. Is that realistic? Yes, I can go to a high interest savings account right now and get even more. So now it's time to once and for all prove that you can beat the market by being greedy when others are fearful, or else you can't, and you should stop timing the market immediately. Oh, it started. This is Andrea versus Moose over 3 months. This is based on real historical all ordinaries data. So we started it in September 1984 onwards. In blue is Andrea. What's that step? Well, remember, they're getting $1,000 a month. They're both getting exactly the same amount of money. But Andrea shoved her straight into the stock market, and hence you see the rise and fall in the stock market, although it's somewhat subtle. But quite clearly, Moose isn't. And that's why the red line, which is Moose's line, isn't wavering at all, because she's still 100% in cash. Of course, Moose is getting bank interest rates, but she's getting no growth in shares. Over to 1 year. Well, blue at the moment is winning, which is 100% of your money in the stock market. And it appears Moose has gone nowhere near shares, still 100% in cash. Okay, I wonder how this is going to work out. Over to 2 years, Moose is still 100% in cash, and Andrea, which is 100% stocks, is actually doing rather well. So good job. Over to 3 years. Oh, Moose, what are you doing? Come on. Still 100% in cash, and of course shares are running away. This is the feature of this particular strategy, or the weakness if you want to think of it. When the stock market is rising, and of course it can do that for a number of years, you've got to sit in cash and wait patiently. So we'll wait. 4-year period. Okay, the market has crashed. Let's zoom in and have a look. When the algorithm detects fear, which quite clearly it has, Moose immediately buys shares straight away. 100% of the cash is now gone into the stock market. She catches the tail end of the stock market, but you notice that because Andrea has actually grown so much, although the stock market did drop, by the time Moose got to buy in, her cash was not worth near as much, so she actually underperformed. And that's interesting. In this particular strategy, once we buy into shares, we actually stay there. This is not a trading in and a trading out. This is a timing in, and then after that, essentially you become buy and hold. Now, any new cash you get remains as cash, waiting for the next buying opportunity. At the 7-year mark, well, Andrea, which is pure shares, is still well ahead. You do notice there, near the end of the graph, the shares actually dropped, but still not enough. Okay, that's what I was afraid of. At the 15-year mark, our pure shares is winning. The blue line, that's what's going on there. At the 20-year mark, aha, shares did crash a little bit, and yet because they were so high already, it didn't matter, and therefore Andrea is beating Moose. At the 24-year mark, oh, shares are starting to crash. Look at that. That means Andrea, who's 100% shares, her value is going down, although she did start very high. We're right at the point in our graph we're about to enter the global financial crisis. Remember, this is 100% historically real data. So if this strategy can perform any time, then it should be right now. At the 25-year mark, okay, this is it. The blue line actually dropped all the way down through the red line. The red line, which is based on the fear index, actually temporarily was in front. Oh, that's nice for it. Over 35 years, no, shares are still doing better. Although there's certainly been some times when that hasn't been the case. Over the 36-year mark, oh no, look at that, red is in front. So shares, which is the blue line, crashed and crashed hard at the beginning of 2020. Okay, that makes sense. At that point, the fear index was triggered. Moose in the red line was able to put 100% of the cash he had on hand straight into shares. So well done, you're buying at a deep discount there. When the share market recovered, Moose is in front, hooray! So in that case, waiting on the sidelines until the fear index triggered actually was the right decision. How interesting. Over 37 years, oh look at that, red is in front, wow. And over 38.7 years, which is all of our data, the winner is red. Who is red? Moose. She buys shares only when fear is above a threshold, and Andrea in blue, dollar costs average the second that she gets some money. Based on our data set, we've proven that you can actually beat the stock market using this strategy. This all comes from an amazing question that jumped the question queue because of a generous thanks. So, if you, like Ivan, can't sit and wait in my question queue for the next 2 years, and why should you? Your question's far too important for that, then hit the thanks button below this video. Over the 38.7 years, Andrea returned 90,300%. Wow! And Moose was higher at 107,000. Okay. And you can see the CAGRs there. CAGR is compound annual growth rate, but remember, this is not just the stock market. They were putting in $1,000 every month. Also, keep in mind that this is the actual price index, so we're not doing total return here. Dividends were not factored in. Why? Why not? Because anything that analyzes charts, so the 200-day moving average, the relative strength indicator, the fear and greed index, so 100% of these technical indicators are purely based on the price because the dividends are all paid out throughout the year. But using my extreme powers of simulation, I'm able to take the price-triggered data and apply it to this. This is the ASX total return plus franking credits over the last 10.3 years. Because we're now using a special, more limited type of data, franking credits and dividends, we're now limited to 10.3 years rather than our 38 years. But the 10.3 years is real data, not an estimate. So historically accurate dividends and franking credits, and that is highly useful. This is year one. Oh, Moose is sitting 100% in cash. Typical. And the stocks are actually going fairly well. In the first test, we went back all the way to 1984. Here, no, this is just the last 10 years. Over 2 years. Aha, what's happening? No, nothing. Absolutely nothing. Andrew's totally in shares, and Moose still sitting in cash. Over 3 years, blue has actually come down and is more or less equal with the red line, but that's not because Moose's strategy is kicking in. It's just that shares have come down a bit. Over 5 years, yeah, Andrea is running away. Okay. Over 7 years, Moose, 100% cash, waiting. We're about to go through the 2020 COVID lockdown crash, so watch what happens next very carefully. Blue, which is 100% shares, plummets down an incredibly steep curve, and of course, the fear index is triggered. Moose, which up to this point has been 100% cash, hits the buy button and goes straight into shares, buying at a discount when fear is at its most. Be greedy. When others are fearful, it's actually happening in front of you. And when the stock market recovers, Moose, who's now in 100% shares, actually does rather well. Over 10.3 years, which is our complete data set, who wins? Oh, it's Moose. Aha. Interesting data. We won again. But how much did they actually earn if they implemented this strategy? Over the 10.3 years, Moose came away with $149,745. Oh, well done. And Andrea is $145,408. So not bad, but not quite as good as Moose. So what have we discovered? Using the Fear and Greed Index, which I created specifically for this video, we have clearly shown that we can beat the market, but it does require that the stock market crashes at some point. And other than that, you actually sit on the sidelines in cash and wait. Actually, this is the very strategy that Warren Buffett uses. Because of the huge amount of cash that Warren actually stores, he's been criticized about it. There was, in one of his meetings, a person stood up and said, why did you not just invest that cash in the S&P 500? You would have done a lot better off. And Warren Buffett said, yeah, I agree. We would have done a lot better, but then we wouldn't have had that cash when we needed it. And having a giant pool of cash, although you're underperforming, does allow you to swoop in and buy up big when the market is fearful. So what should you do? Invest your money as you get it straight into the stock market? Or should you keep your cash on the sidelines and only buy when the market is plummeting? For me personally, I think we need to examine this strategy a little bit more closely. How does it perform for the NASDAQ 100? How does it perform for the S&P 500? And how does it perform over different periods of time? So in future videos, that's exactly what we will do. We will do a thorough analysis to see if this strategy actually has sustainability. Would you like to never lose money on the stock market? Yes. Does this factor in tax? Yes. Click here to find out about that, or if you've seen that, click here.